Hello and welcome to Long Verticals and Diagonals. My name is James Boyd, standing in the stead for Ben Watson, who is on his way to the Anaheim event. So he asked me to teach this class. You guys and gals are in good hands today. Myself and Michael Fairborn will help you here today as we tackle the specific topic of long verticals. Today we're going to really talk about why long verticals are very important in a stock portfolio. I want to kind of talk about one of the things I don't think I've ever really said. Why long verticals or verticals in general are important if you're even a stock trader, okay? And we'll cover that topic on the other side of just real quick as we talk about disclosures. Now, remember, when we talk about options here today, remember the options carry a high level of risk, not suitable for all investors. Also, remember, it's important to understand that all options are not equal. So today we'll talk about the option Greeks and what they're really telling us and the strategy behind different types of options. Remember, the information here is provided for general informational purposes only. Also remember that all investing has risk, including loss of principal. And also remember, when we talk about probability analysis, that's theoretical in nature. It's not guaranteed. It's math, okay? It's an approximation of what those probabilities could be. And we'll talk about that here today. Now, what we really want to focus on here today is the long verticals, how it can complement a stock investor who's trading and or investing in stocks or ETFs, okay? Now, by the way, this could be even for potential ETFs, okay? I won't do that here today. Tomorrow, Brent and I will do that in the morning, okay? But I want to kind of talk about some examples of what the long vertical is, why it's important. So first off, let's kind of kick this off for just a moment. I'm going to pull up, let's say, just the good old SPX, okay? And if we back this chart off for just a moment, and we said, hey, I want to go back on a 3-year weekly chart, and I want us to imagine that we went door to door in my neighborhood and said, hey, it's James, neighbor down the street. Are you investing in the market? And they might say, well, comments such as, well, stock prices are too high. I can't buy that many shares, okay? And if you were to ask someone in the 20, 30, maybe 40, mid-40s, they might say a lot of stocks are high priced based on where the index levels are. So it's, in other words, they want to invest, they just don't have the money. Or if they do buy some shares of stock, it's not really that much. A lot of the stocks they might look at, example given like Costco, they might say, yeah, I want to invest in, let's say, a stock like Costco, but I can't buy that many shares. So how does the investor trade something like Costco? So first off, number one, it's a money issue, flat out, okay? Just say it. It's a money issue. I don't have $900 to buy one share of stock. Fair. Second, it might be an educational issue, okay? Well, let's kind of talk about how to take away the money side of it and the education side of it as we talk about the long call verticals, okay? Now, so first off, you need to understand if this index of the market, S&P, Dow, Russell, whole 9 yards, if they keep going up, what do you think is going to happen to individual stock prices? They're going to go up with it. So it's not that people can't buy stocks, they're just going to be more expensive. So I think having a strategy becomes very important. Now, to give us an example, that also by not having what we're talking about here today, it kind of leads someone down a path where they might say, well, I'm going to buy stocks, but I'm going to buy stocks of lesser quality and unproven businesses. That doesn't sound like fun at all, because how do you know they're going to make it? The odds are almost stacked against you, okay? So by not incorporating or considering long verticals, you're kind of opening yourself up to, if you said, I'm going to buy cheaper dollar stocks, they're not proven. They don't have good income statements. They don't have good balance sheets. They're not on the index list, right? They're maybe not in the sector list either, okay? So we're going to talk about buying stocks like we normally do here today, but I want to talk about long verticals on higher price dollar stocks. What is higher price dollar stock? I'm going to say anything that's over $200, okay? Anything that's over $200, that's what we're going to say is higher price dollar stock. Now, example given, if I looked at the stocks of the Dow itself and said, how many stocks are over $200? Answer, half the list. So if I were to ask someone, why don't you buy Dow stocks? They might say, too bloody expensive. Okay. Well, wonder if we could take the long call vertical and trade half of those stocks. Okay. Now, everything that we talk about in terms of stock trading, we're going to now apply to options. And I'm an open book. Okay. So when we talk about the different scripts that we actually talk about, stocks, options, futures, Forex, interest rates, all of it, we use the same thing. Wouldn't change it. Now, what I want to do is let's kind of introduce, let's kind of start with the most basic. And what I want to do in this case is I want to bring up a long call. Okay. So we know that, for example, a long call, now this is IBM, okay, IBM, and we bought a long call. And that long call gives us what, right? The long call gives you the right to buy the shares at 195. Okay, fine. The right's not free. You pay 585. Okay, fine. So we actually can, for example, buy the shares at 195 plus 585. So at expiration, our break even is, if I added this up, it's just going to be $200.85. Okay, so that's the break even. So if we're above that break even, which we are by about $9-ish, that's the intrinsic value. It's about $9 of intrinsic value. Okay, so we should have about a $900 gain. We do. It's $1,100. Why is there $1,100? It's because of that time decay, or that time, I should say, that's also included in the option value. The long call is wonderful if it goes up. Okay, if the stock goes up. If that stock actually goes up, we buy it at 585. It's now at $17. And now we've made $1,100 on a $500 investment. We're at like 200%, and we're a stinking genius, right? That's if you get the direction right. Now, if the stock were going to go sideways, okay, the con is that negative theta. Can I get a boo? Okay. Now, I'll be honest with you. I don't like negative theta. Okay. I just don't like it. Okay. Now, you're entitled to what you like. I can actually say what I like. Okay. I just don't like it. I think that's a con. Okay. So if you buy a long call by itself, you are thinking this is not going to go up slowly. You're forecasting that it's going to go up quickly. You don't know that. You're speculating. Okay. Now, each day, approximately, assuming volatility stays flat, that theta is eroding away the value of the option. Okay. So the good thing about that long call, unlimited upside, no doubt. Okay. The bad side of that trade is that negative theta decay. Okay. Now let's take this and now kind of talk about, well, maybe the other bad part about this is the break even, right? We need this to go up. The stock needs to go up to a certain point just to break even. So the long call vertical, what we're trying to really do is, number one, lower the break even. If you lower the break even, it's a lower debit. Number two, you are also trying to, for example, lower the theta. Now, wait. When you do that, what have you just done? Well, it's changing the potential upside and the max loss as well. Now, in our example that I want to cover here today, I want to go to Casco, okay? And I want to pull this up. Now, I just want to see Harry, Kevin, Nora, Herman. Be honest with me. How many of you have not bought some of these higher price dollar stocks because you didn't have the money to do it? Now, here's the deal. Myself and Mike Fairborn, look, we don't have an infinite basket. We're not the Fed either, okay? So all of us here should say, I don't care if you had 10 million bucks, okay? At the end of the day, you run out of money. I know that might surprise you, but you'd be surprised. Okay. So even if you said, I want to buy 100 shares of Costco stock, that's $90,000. And that's per the position. You know, they're probably trades. So we're going to talk about, for example, trading Costco through a long call vertical. Okay. Now, think of like the long call. When we did the long call on IBM, we didn't say, man, we're going to make it in 3 days. The problem is we're trying to get that exposure to the trend. So the duration that we pick is important, okay? So typically, you're trying to go far enough out but not so far. Okay? Because you're trying to go far enough out that if you wanted to sell it with maybe 10, 20 days left, that you could. Okay? Or you could at least try to. You'd have to check liquidity. So when we set up a position like on a long call vertical, the minimum would be 20 days to expiration. Minimum. And we're going to focus on monthly options, so the ones that are in that white font. Okay? Now, what I'm going to do is I'm going to open up the expiration for the 18 October, 36 days to expiration. Now, on a long call, you got the bid-ask spread. Okay? But the problem with a vertical is you got not only a long call, the bid-ask spread on that, you got the bid-ask spread on the short call as well. What's your point? The point is it better be something liquid, okay? So the stock on average better have 1 million shares or above because that's probably going to influence the spread. Now you got to also understand something, and I'm showing you this on purpose, okay? When you look at a stock that's almost $1,000, now how many times have you been to Costco? How many times did you think when you're standing there in line, someone's making money in this place? And that's been evident in the fundamentals. It's been evident in the chart, but you didn't have a strategy up until today. Okay, so here it is. Now what I'm going to do is when we buy a long call, why are we picking something 1 to 2 strikes in the money? It goes down to the basic principle is we want to have at least over a 50% chance of being in the money at expiration. We're looking at that probability and using the proxy known as delta, okay? So that's just saying, as of right now, what's the approximate chance it's going to be 1 penny above that strike? So we would pick the 910 or we would pick the 905. Those are the two we would pick, okay? Now, what I'm going to do is I'm going to pick, let's say, the 905. We're going to right-click on this. Now, if you take a look at this, it's $1.20 wide. My gosh. Okay, now I'm going to show you this on purpose, okay? We're going to right-click on the 905, ask of the 905 strike. We're going to go buy, and then we're going to go right to where it says, that's right, vertical, okay? Now, when you bring this up, now we have a decision to make, okay? Whatever the short call is, minus, that's the cap, okay? So think of buying the call at 905 like you have the right to buy at 905 and you have the obligation to sell at 910. Okay? Now the problem is we're already at 912. Okay? I feel like all this morning, every example I pull up, the stock just goes up or the future goes up after I talk about it. It's like I'm sick of that today. Okay? So I'm going to make this one quicker. Now I'm not going to cap it off at 910. We're going to cap it off at 915. Now, when we do this, we see, for example, what the debit is, okay? So if we said, now when we say debit, you're paying this, okay, and you're collecting this. And the net of those two is $550, okay? Why do I want to know that? Well, because if we have a right to buy at 905 and we pay $550, that means the break even is at 910.50. Now, in 25 years of talking to people like in the market, I would say it's almost 100% of the people that say I struggle with investing, they cannot even tell you what the break even of the strategy is. You better know what the break even is. Don't tell me you're going to do it tomorrow. It's today, right now, okay? So if we look at this and say, what's the break even on the trade? 910.50, it's at 912. Anything above 910.50, we're at least at break even today? No, break even at expiration. Now, what I'm going to do in this case, when we come over and do this confirm and send, you're now going to see what is it going to cost. The cost is $550. The debit, since we're buying a call and selling a call, the commission is 65 cents more or $1.30. And we see what is the maximum profit. Now, I'm not going to get into this, but if someone said, why would I maybe focus on long call verticals more than short put verticals? It's an easy answer. You want to have a higher upside. The problem with the higher upside potential is your break even is higher compared to a short put vertical. But someone says, I'm doing long call verticals because I want there to be more money, honey, than compared to a short put vertical. If you're doing them standard 30 to 40 delta, doing a short put vertical, you're not going to make as much compared to a long call vertical where that potential profit and loss tends to be more of a 1-to-1 ratio. Now, what we're going to do is we're going to send this, okay? Now, when we send that, we're going to look and see, can we get that trade to fill? But when I come back up, so now you're going to see this, we can now see what the delta is, okay? Now, let me kind of say a point. I want to make sure every person is paying attention, okay? If someone were to ask me, James, in your experience of doing this for 25 years, why in the world would I consider verticals in a stock portfolio? So let me ask you a question now, okay? Have you ever seen the market pull back? Have you ever seen your stock positions just get stomped out left and right? And at the end of the pullback, you don't have any positions left. You ever been in that situation? It's horrible, okay? I've been there, done that, okay? So you got to understand when you're doing stock positions, those are the trades that are most sensitive to trend, okay? And when markets or stocks pull back, these positions tend to wipe out. And when the market pulls back, what becomes left in the portfolio? For this portfolio, what tends to be left is verticals. Why? Well, because those trades we could probably hold on to because there is a built-in maximum loss. So if the market goes down, 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 these trades given verticals can only get so bad. Okay, now, when the market has dropped and stocks have probably dropped, if we start to go back to the upside, what are the first type of strategies that we're probably in, given a built-in maximum loss? Answer, verticals. Verticals allow us to test bottoms. Verticals allow us to actually kind of endure deeper price troughs, so to say, because the deltas on those strategies are not as high as stock positions or long synthetics. Hallelujah. So you got to understand something. If you've been in stocks and you've been pulling back and all of a sudden when your stocks or the market pulls back, you're very, very, very sad. Some investors might bank on verticals to have some skin in the game, put some new trades on when that volatility is high. And then when actually the trend starts to go back up more, they start to put the stocks back on, cash secured puts in the whole 9 yards. So verticals are huge as far as keeping in the market because the common denominator is when the market pulls back, the investor gets blown out of many of their positions. And when they get blown out, they feel like they got to start from scratch and they have no confidence. That'd be very bad. So that's why the verticals are important because it allows the investor to have skin in the game and they still actually have things that are still trying to work. Now, what I'm going to do is when we bring up Costco, I want to pull this back up and look at this position, okay? As someone who trades options, you need to be aware of when you kind of have different combinations of options, like buying calls, buying puts, selling calls, selling puts. What happens is it changes the delta, it changes the option Greeks, okay? The three main option Greeks I want you to at least be aware of, okay, is delta, theta, vega, okay? So when we look at, let's say, delta, we're really thinking about, is it positive or negative? So if we get, in this case, the delta is positive, that tells us it's a bullish trade, and we're trying to benefit if the price were going to go up. So if this stock goes up $1, the net of the transaction is approximately the vertical would be up $5. Okay, we go up $2, it's 10, $3. Let's say $5, it's 25. If we go up, let's say $10, we'd be up $50. Now, if you said to me, James, I don't have a lot of confidence because I've never done this before. Well, the nice thing about verticals is if we have up or down moves, it's not as sensitive to price fluctuation up or down. Can I get a hallelujah? Okay, that's huge. Now, theta, we don't have as high as theta as if we were just buying a long call, so it's not really a play on theta, slightly negative or neutral. Are we really trying to focus on volatility change? Answer is denied, no. So we're not trying to focus on these two, but we are trying to get the direction right. So when I look at delta, theta, vega, we're saying which one is the highest. And if the highest is delta, then you are trying to get the direction correct. Okay. I'm out. Any questions here? Okay. Now, Harry actually says a couple years ago, I was doing well with Tesla verticals. I got greedy. Okay. Now, this almost sounds like an AA class, but it's really Stocks Anonymous. It's an SA class, Stocks Anonymous. Everyone's gathered around. Harry's going to tell us, hi, my name is Harry. I was doing well with verticals with Tesla, and then I got greedy, and then I fell back down. And he says, then I got shafted. So the more of the stories on these bigger dollar stocks, if it goes right, it can be beautiful. If it goes down and you hold on to it, it can feel like you're holding on to the anchor of the Titanic, okay? And you have big drops in your portfolio because, well, a stock, the risk is all the way down to zero, okay? So that's what's kind of nice is there's a built-in bumper on this, okay? Now, if we take a look at this, okay? I'm going to go back and look at this. Now, I want to kind of bring up an example of like, what is one of these positions? Now, by the way, if we wanted to, and I want to kind of think of this as like verticals, like we said before, the long call vertical has a higher profit potential, okay? Could the investor maybe try to do this as a trade? Maybe something just like a week or two, okay? We saw before like what the maximum gain was, but wonder if on this next trade example, wonder if I wanted to go back to, now, by the way, we're going to use same technical analysis, and you're going to see that one of the stocks that started to poke inside this old channel here today was in NVIDIA, okay? Now, I already mentioned before, and I posted on X yesterday, okay? When you look at the daily chart of NVIDIA, it might not look as interesting, but when you pull up, let's say, the weekly chart of NVIDIA, you'll notice that when you take a look at this on a standard moving average, like a 1030 on the weekly chart, you're going to kind of see that we're trying to get a little bounce right on the upward trending 30 period moving average. Okay. Now, NVIDIA is not a high price dollar stock. So when I look at this and we look at the trade tab and we see that there's 167 million, and we're not even in the middle of the day. Okay, that's like what you think for the S&P 500, for crying out loud. The product that tracks the S&P 500. Okay, sometimes the activity of NVIDIA is like it's like trading like an index. Okay, a product that tracks the index, but it's just a stock. It's like an index unto itself or the group. Okay, now here's what we're going to do. We're going to take the same practice. Let's take one more, but I want you to see the differences. Lower price dollar stock, high volume, but notice the bid-ask spread, okay? 5 cents on the bid-ask spread. On the 119, could we go, for example, like the 118? 10 cents on the bid-ask spread, okay? Now they're moving on us, okay? Let's say we want to have a greater chance to be in the money and potentially a lower break even, okay? Let's look and see what the break even differences are. We're going to take the 118. I also want you to notice something. On something that has higher volume, notice that there's different strikes, okay? So when I look at those, I want to kind of bring this up here, pull that up. I'm going to put that theta. I want to take a quick look at volume, and I want to take a look at open interest, okay? So tell me what you see on volume in open interest columns for the strikes. Nora, what do you see? John, what do you see? Chris, okay, what do you notice? Now, open interest, that's the number of contracts that are open and on exercise coming into today. They're open and on exercise. This 18,000, these are the contracts that were bought or sold. They are not netted off. Repeat, they are not netted off. So if I buy one, that's +1. And if you sell one, that's +1. That's 2. Okay? So the higher the number, the more activity of buying or selling. We won't know until tomorrow what that open interest number was. Okay? So first off, when you get volume that's almost as high as, let's say, the open interest, That's a lot of activity. Okay. Now, what we're going to do is I'm going to right click on the 119. Okay. We're going to go buy vertical. Okay. Now, what I'm going to do in this case, let's assume that I only have an account with like 10, like say $6,000. That's it. That's all I got, 6,000. Okay. And what I'm going to do is I'm not even going to do a $10 wide strike. I'm going to do like a $5 wide strike. Okay. So if you ask someone, now, by the way, how many of you have kids? How many of you have grandkids? Okay. And they're probably going to ask you a question such as, I'd like to get in the market, but I just don't have that much capital. Okay. And let's kind of imagine that they said, look, I got $6,000. I'm learning how to get started, but I want to trade better quality names. I know I can't buy as many shares, but I want to try to get exposure to what the trends are. Welcome to verticals. Now, that doesn't mean you're going to do it, but you're learning about it, and then you consider for yourself if it's something you would consider. Now, we're going to buy the 119, okay, which is, as of right now, kind of the at-the-money strike. We're selling the 124. You got a debit of 220. Now, James, what happens if I did like the 118 and I did, let's say, the 123? Okay, I got not traded on that, and if I go back to that 119, 124, okay, here's what we get right there, the debit there. Now, I think that's kind of interesting is, yeah, they don't have a 123 strike, which that's a little unusual, okay? Now, if you take a look at this, the debit, that debit is the most we could lose given the vertical, okay, per contract, okay? So if we had $6,000 and we lost 223, that's going to be about a loss, $223 on a $6,000 portfolio, okay? You're down 3.7-ish% on that one trade. Of course, if you have a lower dollar amount, any up or down movement has an amplified effect because of the lower balance, okay? If I go confirm and send now, we see that we have a trade here that we have the break even. So we have the debit, 223, check. Where we have a right to buy at 119, check. Add those together, gives us the break even. So we do need this stock to go up somewhat just to break even. Now, remember we said on a long call vertical that, for example, that the max profit, max loss would be more of 1-to-1. This is slightly greater than 1. Position sizing is quite simple. If you said, James, I could risk, or I'm willing to risk 300, it's whatever the max loss is. Okay, so if I could risk 300 and the risk per contract is 223, one contract. If I said to you that we could risk $600 a trade, we could go all the way up to 2 contracts. The entries are the same on stock positions. Now, you might say, well, James, I'm willing to take more of an aggressive entry because these are not as directionally sensitive or a higher delta as stocks. I'm not going to argue with you. I'd agree with you. That's when the investor might say, James, that's why I'm going to take that moving average just going green and not waiting for the crossover or waiting for the 20-period moving average to go green. Noted. Okay? You're right. I wouldn't argue. Okay? Send. Now, if we take a look at this, it fills, it comes back to the position. What do we have? So we have a long call vertical, and that's what it looks like. I want to bring this back up just real quick on the Analyze tab. I'm going to tell you right now, when I saw this tab for the first time, I absolutely lost my mind, okay? Because I had never seen anything like it. I thought to myself, do you have to be like an engineer, okay, to really use this? Is it really helpful for me to see this chart? Now, how many of you have had that reaction when you saw this chart? You're like, dude, I don't even know where to begin. Okay, now, this diagram is not that bad, okay? It's just showing, for example, the profit loss on the left-hand side. Okay, that's not bad. On the bottom, it's just showing the stock price. Okay, so that's not bad. And what you're now going to notice is on this chart, this is just showing the MG, the maximum gain for the one contract. So what it's doing is it's diagramming the position. Okay? So it says, it's just saying for one contract, what's the maximum gain? It's near $300. And if you said, well, what's this bottom line? It represents the max loss, the ML given the one contract. That's not that bad. Okay? So on a vertical, okay, if the stock goes to the right or up, there's more potential profit. That's all the diagram is telling you. Okay? Now, awkwardly, we see these little two red lines right here. That is break even as of today. And this second one is break even at the expiration. So one of the most commonly heard questions we hear is, well, if this stock goes up, let's say $5 today, what would my position theoretically do? Well, let's kind of move the cursor to the right. If we're sitting here at 118 and we go up $5 to the right, or the stock goes up $5, that one contract would gain about $46. Okay, about $46. Now, if you might say, well, James, can I change this assuming that I did 3 of them? Same thing. If we went up to, let's say, 123 and change, and you had 3 contracts, it's going to adjust. It's going to help you see what the potential profit or loss could be. What if it goes down? Well, if we go down to, let's say, 113, go down $5, and I have 3 contracts, what is the potential loss? I think that's helpful. Okay? So that way you can kind of see if it goes up, if it goes down. Okay? And the other thing you could play with is the date and say what happens to, let's say, if it stays exactly where it is over time, what does it do to the position? So this is like drawing kind of your profit loss over time given price moves and changes in time. It's also stating the probabilities in certain areas. Now, want to kind of make sure that you know something. When you go, for example, to the Trader Talks channel by Schwab Coaching, okay, one of your questions might be, is there a specific class on this Analyze tab? Okay, you do not have to have a pocket protector to get that tab, okay? So if I go to what I just sent you, you're going to see that there's a little search, okay? We know that's the icon. You don't even need to speak English. We could be in Greece, and we know that that icon means search, okay? Having a little fun with you, okay? Click on that search right there. Okay, now, if I said I want to learn about the Analyze tab, well, search for the Analyze tab, okay? When you subscribe free, you could actually just say, look, I want to search on this channel, Trader Talks Schwab Coaching. When I do that now, it's going to pull up anything on our channel on learning about the Analyze tab. And you can pick if you say, I really enjoy Brent, or I enjoy Mike Fairborn a lot more than you do, etc. You can pull up any, or I enjoy Connie, or whatever. You're going to see that those are all the classes that we've done over months and years on that topic. Have at it. Okay. Now, I want to talk about some positions that we currently have, and kind of now let's talk about kind of some good and bad. So in this case, what you're going to notice is, okay, we did 2 new trades, right? And I want to talk about positions that we have. And the example of Apple was put on the 27th. So it was about almost 2 weeks ago, we put on the Apple trade, and we bought the 225. Okay, fine. And we sold the 230. Okay, fine. Okay. Now let's draw that diagram up again of what it's going to look like, right? Max loss and then max gain. Now, what you're now going to notice is what was the debit? Okay, there. Well, you paid that $10.85 and you collected this $7.85. Well, if you look at this, if you had a debit of $3 and you have a right to buy at $2.25, we know the break even, the $2.25 is right there. Okay. And if we added $3 to this, we get a break even of, let's say, $2.28. Okay. Now that's the break even. $2.25 is the long strike. $2.28 is the break even expiration. All we're going to look at it here is kind of say, well, where's the stock now? Well, We're over here, 222. So if we're lower than the strike that we bought, we're lower than the break even, do you think we're profitable or we're losing? We're losing, okay? Now, if we said on this trade, we got 2 contracts, okay? You paid $3 for them, $5. So you got a $5 wide spread and you paid $3 for each one of them, okay? The max loss per contract is $2 a contract. But the thing is, we got 2 of them. So if you said, what's the most? I mean, if it got horrible, given this vertical, what's the most we could lose? Answer, 400. We are down 160 of the 400. Okay? So if we said, well, like, what percent of the max loss are we down? We're probably down about 40% of max loss. Given the vertical, we could lose another $240. Let's pull up Apple. Now, by the way, are we running out of time? Not necessarily. Got 36 days left. But we need this stock. If that stock is at 222, I would feel a lot better if it went to the long strike, and we would feel a lot better if it went to the break even. And we would feel a heck of a lot better if we went to the short strike of the 230. And why does that line go from being up to sideways? Because this up here is your cap. So we would feel really happy if all those Samsung users finally admitted that their phones are inferior compared to Apple phones. Oh, I thought I was muted. Okay. Okay. So maybe let me go back. Okay. Maybe some other people that have phones decide that they want to up their phones to Apple phones. Okay. All right. Thought I was muted there, but I wasn't. I'm joking. Okay. Now, so that's why we're down. So if I go look at, let's say, the Apple position and say, what do I do with Apple? Well, it's not that Apple's doing horrible, but it's kind of in that little pullback stage. Okay. Now, I'm going to kind of throw something out here. Okay. If I said, hey, James, if we go lower than 217.59, which is where this last pullback area is, I don't want to be in that long call vertical if we go lower than that. Can I create a conditional exit if we go lower than that? Of course. Okay. So we're going to go back to the monitor tab. And the whole purpose of that is where you're trying to really say, in this case, hey, I'm okay with losing some of the max loss, but I don't want to lose the whole max loss. Okay, fine. We're on the same page. We're going to so what I need you to do is I want you to hold the shift key down on your computer. Okay? Okay, hold the shift key down. And hold it down. Do not let go. Okay? Click on both lines. It highlights them. While holding the shift key, right click, create closing order. We're going to sell. Now, what we're doing is we're saying, look, exit the vertical if the stock goes at or below that 217-ish area. The way we could do that is limit to a market, day to a GTC. We're going to go over here to the right-hand side. Okay, click on the gear. Now, what are we doing? Well, we're kind of using probability analysis / options with technical analysis. Okay? Now, what I'm going to do in this case is, and I'm going to pull that up. Something got behind me somehow. Okay, what we could actually do. It froze on me there. Yeah, it froze on me. So all we're going to do is we're going to go to that little gear right there. Okay, I'm going to go to the gear, and all we're going to do is we're just going to say, look, the mark price of Apple. If we get at or below a certain price, we're going to type in 215. And if that stock goes to below 215, it's going to exit the 225 call, which we bought, and we're going to buy back the short call because we sold it initially. Okay? So that's how you can really use technical analysis, okay, to really trade verticals. So if you said, I want to trade verticals, I don't want to take full max loss. I'm willing to take a portion of max loss, but not full max loss. That's how an investor does it. Now, someone might say, well, do you take this? Do you exit off the stock price or do you exit off the option price? Our answer would really be that we like, for example, the stock price, because it's not kind of related to, it's not, we're trying to exit if we get at or below a certain area on the chart. Option prices can move irregardless of the stock price if it moves. Volatility, okay? Market conditions can affect the option prices irregardless, even if the stock moved, okay? If the VIX today went to 50, it could have a dramatic price change on options, and the stock didn't break support. So that's why in our examples of targets and stops or conditional exits, that's why we actually like to set the exits or targets based on stock prices, okay? Now, I want to go back to something just real quick, and I don't know why that kind of froze up, but we'll go back. Let me just bring this up and kind of work with that. Yeah, it kind of went full. Okay, we'll work with that. Okay, so let's kind of go back to something. Now, what I'm going to do in this case is let's bring up any questions that you have. Okay, any questions there? Now, just real quick. Yeah, the max loss is $300 a contract in that last example, and I believe that was Apple. That's true. Okay, now, I wish I could, for example, I'm going to try to actually do this. I'm going to see if I can't shut that down for just a second, because there is one example that I wanted to bring up, and I'm going to try to, I might not be able to. Yeah, froze. It's weird. Okay. Now, I want to talk about an example of like a positive gain. Okay. So I want to kind of bring up an example. If we have the IBM example as well, and I want to actually, it's the Meta example. If you have a gain of 50, 65, 80%, and you say, James, I've done well on my previous trade, I want to profit take, okay? So if we had, for example, let me just be 100% clear on this, okay? If we had 80% gain ever, okay, we would talk about exiting or rolling. That's a new position. You enter a new position because you think that trend could continue. If we have like a 65% gain with more, okay, than 30 days, this is like an 80% gain, okay? Because you don't have a higher percent gain because you still have 30 days left, okay? If, for example, you got 50%, okay, in the first 2 weeks, and there is plus, let's say 30 plus days to expiration, that's like a home run. If you get 50% in the first 2 weeks, that's like smashing an 80% ever, okay? So that's kind of how I think about that. 50% would be the minimum profit that we're trying to take, assuming you don't want to just get out. 65%, if we had 65% and there's 30 days left, that's like 80% because I still have 30 days left. And if we get 80% ever, so if I had 10 days, 15 days, 20 days, 3 days, whatever, ever, that's like a home run grand slam. If we said, well, when do we get the 100% gain? The only way you get the 100% gain is you go all the way to expiration, which is not very likely, typically. Or you got to get, if you said, when can I get near that? Okay. You could probably get near that if the stock really went up in your favor. But you won't get the 100% typically. The only way you get the 100%, you got to go all the way to expiration and let them expire. You get close, but the only way you get the 100% is you got to go to the expiration. Okay. Now, I got to wrap this up, but what I want you to do is on the Meta, my point with Meta is on our previous trade that I, for some reason, can't show, we had like a over 65%. I wanted to show the example of rolling. That rolling is just we're exiting the old position and entering the new one. And like we said before, if the investor said, you know what, James, I would like to enter because I'm seeing a green line on the shorter term moving average. I'm seeing the crossover too, and I'm trying to get in. Like we said before, the entries on these are the exact same as stock positions. Your assignment is, I want you to think back to, have you missed opportunities of using verticals, long verticals, to complement your stock or ETF portfolio? Have you felt left out on these higher price dollar stocks because you didn't have confidence or the education to use these? I think when you step back for a moment, you might say, geez, maybe I'm going to incorporate that. That's your decision in your own portfolio. Okay. Think about that for yourself. Now, I'm out of my time here today. Remember, coming up next, okay, so if I go right back to that little home section and I pull up the live streams, coming up next, we have Adam Lynch, 8 stock selection myths. After that, I'll come right back and do actually trading with a trend. And if you want to kind of see, well, what would be something like this that would be more probability based, Michael Fairborn will be doing that class coming up shortly as well. If you'd like to kind of see a bullish trade, but the flip, Mike will actually talk about the short side of this as well. I want to thank you so much for your comments and your participation. And stay tuned for Adam Lynch coming up shortly. Thank you, Michael, as well, and to all of you, because we've had a lively session on why we might consider long verticals in a stock portfolio. With that said, thank you so much. Take care, and I'll see you in a bit. Bye-bye.